The U.S. Senate had agreed to extend emergency debt ceiling to early December in a bid to avert a debt default in mid-October, Senate Majority Leader Chuck Schumer announced on Thursday local time. Although the Republicans and Democrats have reached the agreement, the fundamental contradiction on the issue between the two parties remains unsolved. The short-term spending bill passed at the end of September to avoid a government shutdown will expire on December 3, meaning that the U.S. Congress needs to deal with the issue of government funding expiration in the same period of dealing with the emergency debt ceiling issue. Treasury Secretary Janet Yellen warned that if Congress does not resolve the debt ceiling issue in a timely manner, the Treasury Department will exhaust its borrowing space on October 18, and the federal government will face its first debt default in history. With regard to the Senate agreement on the extension of the emergency debt ceiling, economists of the White House warned Wednesday that a possible debt default of the federal government may trigger a global financial crisis. Jared Bernstein, member of the Council of Economic Advisers (CEA) of the White House, said that the Senate agreement on extending the emergency debt ceiling only pushes the issue aside and does not root out the problem. The problem should not have been developed to the present situation, said Bernstein. Cecilia Rouse, chair of the CEA, said in an article on Wednesday that the possible debt default of the federal government will hinder the normal operation of the government and have a serious impact on the U.S. economy and the financial market. Then the sovereign credit rating of the United States may be downgraded, the dollar may be depreciated and the interest rates may be widely raised, which may result in a recession of the U.S. economy and a freeze of the country's credit market, according to Rouse. White House economists also pointed out that as the U.S. Treasury yields are the basis for the pricing and trading of various financial products around the world and as the U.S. dollar is the world's major reserve currency, a U.S. debt default will also impact global financial markets, leading to the freeze of global credit markets and the decline of stock markets. As the current global economy has not fully restored from the COVID-19 outbreak, the global financial crisis triggered by the U.S. debt default may be worse than the 2008 international financial crisis, according to White House economists. The political polarization of the two parties in the United States, the failure of the governance system, and the frequent deadlock over the U.S. debt ceiling have forced investors to take seriously the possibility of a U.S. debt default. According to research released by Moody's Analytics, if the debt ceiling issue of the United States remains unresolved by November, the real gross domestic product (GDP) of the country will shrink by nearly 4%. The unemployment rate will rise to nearly 9%, the number of job positions will reduce by nearly 6 million, and the U.S. family wealth will shrink by about $15 trillion. Then the U.S. Treasury bonds will no longer be considered as risk-free assets, and the country's household and corporate borrowing rates will soar. Chief economist of Moody's Analytics Mark Zandi said that timely debt repayment by the U.S. government is the cornerstone of the country's economy and the global financial system. If the United States sees debt default, the country itself and even the world economy may return to recession, said Zandi.